particularly for our part of the world, U.S. foreign policy has not been very good for the Middle East. And that's not good for human lives, and it's not good for business as well.
We will measure our success not only by the battles we win, but also by the wars that we end, and perhaps most importantly, the wars we never get into.
When you walked in here, I asked you, what's good that's going on? You told me peace is good.
Yes, absolutely.
Yeah.
We've seen a president and a prime minister in Lebanon, a ceasefire in Gaza. I mean, these are very good news.
Yeah.
The ceasefire is a crucial step towards achieving peace and prosperity in the Middle East.
How do you approach a negotiation?
The way to win a negotiation is focus on what matters to your economics, i.e. how much money you're going to get. Understand what's important for you.
Yeah.
Pick your battles. You know, the worst thing that people do in this part of the world is everything is their battle.
So what goes wrong? Hello, everyone, and welcome to Conversations with Lulu. I am Lulu, an entrepreneur, a venture capital investor, a mother, and your host. We're taping this episode on the day after President Trump's inauguration speech, and it feels like a new era for the US. But what does it really mean for us here in the GCC? To help me unpack this, I am joined by Ziad Awad, who is the CEO of boutique investment bank Awad Capital. Ziad is a capital markets and mergers and acquisitions expert. You've probably seen him sharing his views on Bloomberg Al-Sharq and Al-Arabiya. Before founding Awad Capital, Ziad led Merrill Lynch here in the region and was head of Middle East debt capital markets at Goldman Sachs. At Awad Capital, he's helped numerous companies, both in tech and non-tech sectors, raise funds and also negotiate exits. So in this episode, we're going to dive into the macro environment and what a Trump presidency could mean for this region. We'll also discuss the art of selling a company, what can go wrong, and the secret to successful negotiations. So let's dive in. Ziad, it's great to have you here.
Thank you. I'm so happy to be here finally.
Yeah. So did you watch the inauguration speech last night?
I did.
Yeah.
I enjoyed it.
It was a spectacle.
Yes.
It was a show.
Yes. I think there's a lot of politics in what he says, particularly when he denigrates the performance of the previous administrations and when he promises huge things for the future. But to start on a positive note, what I really found very positive and encouraging is when he said he wanted to be the president that gets remembered for making peace and for avoiding wars. And I think that's very encouraging.
Yeah.
Because that's particularly for our part of the world, US foreign policy has not been very good for the Middle East. And that's not good for human lives, and it's not good for business as well. So if he can, avoid more wars and more disruptions in the Middle East, that's the best we can hope for.
Yeah, he did speak about the wars we don't get into as well.
I thought
not that we get out
that was a very smart thing to say. Like he said, we want to win wars, but we also want to avoid wars.
Yeah. So MAGA economics, make America great again. There were a lot of announcements yesterday. One of them is drill baby drill, as he said. So what are your thoughts on that?
So what Trump is saying is by drilling more oil, he'll make energy more affordable and reduce inflation. That is a potentially valid comment, but the concern there is when you see California burning, and the fact that the U.S. has a record amount of natural disasters, including hurricanes, fires, droughts, and others. There is scientific evidence that these natural disasters are linked to the use of hydrocarbons. That's why governments in Europe and previous governments in the U.S. have tried to encourage the use of renewable energies.
So you think that would put a damper on their ambitions to invest in renewable energies?
Yeah, he gave a number of orders to reduce the encouragement of renewable energies, reduce the subsidies, for example, for buying electric cars. Not a single windmill will be built during his
he doesn't like windmills.
Yes, exactly. So these things are all in favor of burning more fossil fuels, which is bad for the environment.
Mm-hmm. Yeah. But on the economic side, I mean, I understand the environmental point, but on the economic side, would that help alleviate inflation? Would it help drive interest rates?
Well, for sure
down?
That producing more oil locally and reducing the price of oil reduces the cost of at least the fuel that the American consumer consumes. That's an immediate benefit, and obviously. Petrol prices and energy prices are a key part of the CPI, which in turn has an impact on interest rates. But he's not the one who decides on interest rates. It's the central bank, the Fed decides on short interest rates, and bond investors decide on long rates. So he needs to, make sure that those two constituencies get interest rates to, where is the right place.
Yeah. I mean, I'm going to get to why is this important, because obviously everything in this world is interconnected, right? So something that happens in a global economy like the US will trickle down here.
Well, there's a big links between what happens with the US economy and policy in our region. The first one, which we should never forget, is that our currency, whether it's the dirham in UAE or the riyal in Saudi, are pegged to the US dollar. Mm-hmm. So when the US dollar goes up or down, our currencies also go up and down against our main trade partners, which are Asia, Europe, in addition to the US as well. And obviously the price of oil that we export is denominated in dollar, which is the main source of income still for the GCC economy. So that's the first link. The second link...
So what does that mean? What happens then? So a strong dollar means what for our economies here? Because we're pegged to the dollar.
Yeah, so strong dollar, when it happens, impacts... let's start with Dubai, where we are. For example, it impacts immediately the tourism in Dubai. Mm-hmm. So it makes Dubai less affordable as a tourist destination, which makes sense if you think that currencies like the euro, the English pound, and the Indian rupee are at very low levels. The Indian rupee is at an all-time low against the dollar, which means at an all-time low against the UAE dirham. Number two, in terms of our main export, which is oil, at equal oil price, as the dollar goes up, oil becomes less affordable as well. Mm-hmm. That's kind of the main link, the importance of the dollar for us.
On the oil point, if the US start producing more oil, what would happen to the oil prices here?
So the intent of Mr. Trump is to reduce the price of oil. But at the same time, not only he's pumping more oil, which supply reduces, right? But also he is encouraging more consumption of oil via more petrol cars and more industrial manufacturing and production in the United States. Mm-hmm. So he's increasing both the production and the demand,
the consumption,
for oil. But net for the GCC countries, it's going to be a little bit of tension because it's also competition on who produces more oil and market share competition, because he wants to export oil. That means he wants to compete with some of our oil that goes to Asia, Europe, and other places.
Mm. So what happens if the oil prices in our region are low?
Oil prices in our region have been low, I think, the last year. And I think the economic activity has been decent, but not buoyant like it was or like it would be if oil was at 90 or 100. I think if oil prices drop further from here, our governments will have less surpluses. So they'll have to be more selective in which projects they invest in. Mm-hmm. But also we will see more of the very healthy capital markets activity we've seen. So the Saudi government in particular, as a way of financing the big projects.
Okay.
So if the government, let's focus on Saudi, which has the biggest projects and the biggest oil. So the government in Saudi has all these giga projects to finance, including for the World Cup and other projects, housing, education, healthcare. So there's two ways to finance these projects. One is natural surpluses that come from selling the oil. And the second one is using the debt capital markets by issuing more sukuks and bonds by the government itself and by government-related entities, banks, real estate developers. All that participates in financing the economy. Mm-hmm. And there's ample borrowing capacity for Saudi Arabia and the debt capital markets. I've been saying that for many years, and they've been very successfully tapping the debt markets.
So there shouldn't be an issue in terms of spending, right, on bigger projects, because you said, I think we started this, you said that they might have to be selective, right?
Correct.
and where they deploy that
they
money.
Will definitely be more selective. And we've seen that at the end of last year, some decisions being taken on slowing down some projects versus some other projects being more prioritized, because obviously, borrowing, money is not the same as, pulling oil out of the ground. You have to be more selective. In general, I think it's healthy to be selective. Saudi Arabia is and remains the largest construction market in the world. So we see a very buoyant construction activity in Saudi, but they have to, manage how much there's an issue not only in financing, but even in finding enough talent, building materials, all this. So these projects need to be managed, and I think they're doing, a good job at it.
So we spoke about potentially the impact on tourism in places like Dubai or the UAE.
Yes.
Even Saudi actually is doing a major tourism push.
Absolutely.
We spoke about potentially oil prices, that there will be competition, but not necessarily a negative thing, right? In terms of like the government's ability to spend. Because you said we could finance projects from oil or from borrowing.
Correct.
What other impacts do you think would happen here as a result of what's happening in the US?
The main impact that we hope for is a lack of impact from a geopolitical standpoint. So the fact that over the last few weeks we've seen...
So peace.
Yes, exactly. We've seen a president and a prime minister in Lebanon, a ceasefire in Gaza. I mean, these are very good news.
Yeah. When you walked in here, I asked you what's good that's going on. You told me peace is good for business.
Yes.
Yeah.
Absolutely.
Yeah.
Peace is good for everything.
Let's talk a little bit about M&A, right? Which is your bread and butter, merger and acquisitions. So tell us here in the regions, who are usually the primary actors, let's say, in an M&A transaction? Who's really driving M&A here? Yeah.
So there are really, very broadly speaking, and I can say it from my perspective, two broad segments of M&A. So most of the big transactions that make up the majority of the volumes when you look at the league tables are made by government and government-related entities who are either investing at home or abroad. So you see these big cross-border transactions which are done by either sovereign wealth funds or sovereign wealth funds-backed entities. And these are the giga deals, multi-100 million, multi-billion-dollar transactions. And then obviously there is a buoyant private sector. This is where us as Awad Capital were active. We're really not very active in the giga deals, which are government-related transactions. But very happy to say that there is a growing entrepreneurship sector where companies are emerging, are becoming profitable, and are getting acquired, typically by other bigger companies, sometimes from the same region, sometimes from outside of the region. So these are really the two segments, I would say, the government-related sector and the private sector.
So let's talk about the sector where you work, which is the private companies that are acquiring smaller companies. So first, it's not only technology, right? So you work across the board.
We work across the sector. Technology is one of the most active sectors in M&A. But right now, sectors like construction, for example, are equally active. Oil and gas, always obviously very active in this part of the world.
So at what point should a founder or an owner consider selling their business? At what point do you come in as Awad Capital?
So the decision to sell a business, it's a very individual decision by founders. Some businesses become multi-generational families and get passed down the generations. Some founders, the majority of people we work with, typically have built a business for 10 to 20 years and did not...
Oh, wow.
Yes.
10 to 20 years.
Yes, typically it's at least 10 years because normally we're dealing with companies which are profitable and, have...
Sizable.
Have at least $5 million in EBITDA. It could be up to $100 million of EBITDA. This is the typical, private sector company we work with. And these companies are big enough, well-established enough to be sold to another company or to a private equity investors, but either are not big enough or the founders does not have the desire to take them public.
Okay. So so you said it's a personal decision for someone to potentially think about selling their company.
Yes.
So how does that process happen? Like what in your opinion makes a company investable or acquirable?
Yes, good question. So there's many criteria that make a company saleable. And in particular, the company needs to be able to run without its founder or founders, if not immediately, after a period of 2 to 3 years.
Okay.
So founders typically, when they're selling their companies, are looking to sell a majority or the full business. And if it's a majority, it's with a path for them to exit after a few years. So whether it's 100% or with the founder staying on board or partial sale, there needs to be a path where this business can run itself and be institutionalized and managed either by a board or by another owner. Basically, it becomes a division in another big company. So that's the number one criteria. And how is that achieved? Is by really hiring the best people, by having systems, processes in place which are well established for client relationships, for execution, for project management. Obviously, the finance function needs to be strong so that the company can, the new owners of the company can understand what's going on financially inside the company. So these key functions, sales, marketing, business development, finance, HR, technology, need to be well staffed so that the founder, who typically does all these things in the early parts of a company's life, can gradually start stepping out under the new ownership.
So typically when a sale happens, the founder would typically exit within either immediately or within a couple of years?
Yes, but this is when we're talking about a sale. But we also get involved in growth capital financing, where the founder is only looking for a minority investor to come in and finance them in their next stage of growth. Yeah. And that can be a founder who wants to continue own the business or eventually take it public, or it can be a prelude to the final exit, which we see a lot of that as well. So founders who come to us and say, listen, my business is $10 million EBITDA, but I only want to sell it when it gets to 20. Here's the path to 20. Help me raise $40, $50 million. I'm going to do acquisitions. I'm going to do hires. I'm going to open offices. It could be one or all of the above. And this is something we love doing as well, is supporting business owners in their growth journey.
And what do you see when you meet companies here from the region, founders who are looking to sell their companies? Are they, do you have that governance in place? Do you have those robust sort of functions that you spoke about? Is it mature enough?
It varies a lot. And the bigger the company, the more you get into the $10 million EBITDA and higher, the more likely you are to see some of these structures in place. Yeah. And the more, experience, the older the company, the more you will see some of these structures. Like some companies even have boards of directors, a big four auditor, ERP systems. So you see some companies which have really the systems and procedures in place, similar to, which are not far from those of a listed company. In the smaller companies, it's less common. We see typically a lot of gaps, and we are used to working with these gaps. The most typical gap, that's the one that creates the most of an interesting challenge for us and for acquirers is in the finance function.
Okay.
So, companies, particularly which have become successful very quickly, don't have time to have a good finance function in place, i.e., you don't have a good analysis on things which you would think are normal, such as, contribution margins, gross margins, what's happening with our general administrative, costs.
So basically them understanding the full details of their business.
Exactly. So we come in with an information request list and we start asking all these questions. And with some companies, it's more difficult than with others. But we make sure that we get a level of information that will be sufficient for a buyer to make an educated decision, and to give an offer that, from a valuation perspective, is fair for the company.
Do you typically work with the buyer or the seller?
We very typically work with the sellers. So our reason of existing is really to support founders, either when they're growing their business or where they're selling it. And that's really what the boutiques are for. because founders like working with the boutiques because we bring this entrepreneurial aspect ourselves. Yeah. We are an entrepreneur-owned and managed business ourselves, and that is the case kind of all over the world with the boutiques serving the SME sector or the private sector, as we call it here.
How do you select the companies that you want to work with?
The first thing is we have a reputational filter. We make sure that from a reputational perspective, the company, the sector, the individuals, we're comfortable, working with them. The second, which is really, and that test is very easy. I mean, most people who come to us are absolutely fantastic people who we'd love to work with.
Yeah.
The second test is really the most difficult one, is to make sure that it's a good company that is, as you very rightly said, is it saleable? Is this a business, is it just a nice business to own for the founder? Or is it a business that actually many people will be interested in owning it? And also as part of that, we establish valuation expectations that to make sure that the expectation of the founders or the expectations of the founder will be satisfied by the demand of the market. Because as you know, there is a lot of founders who think very highly of their business, as they should. And it is our job to advise them about the reality of where we expect to sell the business. And if we feel that there is a discrepancy, that the business owners could be disappointed by the result that we get from investors, we shy away from taking the mandate because we don't want to waste the time of the company or of our investors or of ourselves. It's better for everybody. And the third filter is our fees, our commercial terms, that the company is comfortable with, what we're going to be charging, which, we obviously propose something that's fair, but it needs also to be acceptable to the business owners.
Okay. So what goes wrong?
So many things can go wrong.
So tell me, I'm sure things can go wrong, but...
Things go wrong all the time. So one of the things that goes wrong is if the company, for example, underperforms during the mandate, i.e., they promise a certain growth or a certain profit or a certain revenue and they don't achieve it. Now, that can have two sources itself. In some cases, it's the market, it's not the company. So as I said, last year, many of our clients were involved with consumer or, things that had to do with the war that was outside of the control of the company. The second thing that is...
So that makes it unsellable or...
It doesn't make it unsellable, but you get this divergence on the valuation because usually the investors, the buyers are sticking to the market. They say, okay, we said we would pay, let's make it very simple. We'll pay 100 million for this company. That's based on a multiple of 10 on a profit of 10. Okay? So the 100 gets anchored in the mind of the seller. They're like, okay, I'm willing to sell my company for 100. But then at the end of the year, the 8 is not 8, it's 7. And the buyers say, at best, the buyers would say it's 10 on 7. But sometimes the buyers say, well, this company is not growing or the company is going backwards. The multiple is not 10 anymore, which is their right to say that. The multiple is now 9. So now you're talking about 9 times 7, or like in the 60s as opposed to being in the hundreds. And the founder goes, well, I will wait. So that is the typical reason for M&A transactions in all walks of life to happen. And it's due to two things. Either the market drives that underperformance, but it can also be that the management overpromised. So what we try to do is we also have a responsibility there as bankers is to present business plans and budgets to the market which are realistic. And what we tell to our founders, particularly the very ambitious, which is most of our founders are ambitious and bullish on themselves, is it's absolutely great to have that bullish business plan internally with your team, with your board. But when we go to investors, because investors are conservative financial people, we need to be more conservative. So we try to have a banker business plan, which is more conservative than the internal business plan. And, we tell founders, please do not demotivate your team. Tell them to go for the 10. But if you think there's the slightest chance that we end up at 8, let's please present 8 to investors because we'd rather present 8 and end up at 9 than present 10 and end up at 9. Yeah. But the valuation is not going to change. It will be based on the end number anyway. And you would not believe how hard that conversation is. Even with sophisticated management, even with sophisticated investors who own those companies. But that's something that we're spending a lot of time on with our companies, with our founders, trying to, have a fair, a realistic number to present to the market and be presented even in a more conservative way in the interest of the overall transaction and managing expectations in the right way.
But how do you, as someone who's coming in on the outside, can have a view on this, right? I mean, I can imagine why this conversation is difficult.
Yes.
Because they're saying, okay, you're an advisor.
What do you know?
What do you know about our business and our growth plans and so on?
So two things. I mean, first, we do a very thorough due diligence, just like a buyer would. And we actually analyze more companies than even some of the private equity and then some of the professional buyers. We are analyzing multiple new companies every week. So we're doing this for the entirety of our careers. So that's a lot of companies, which not only we analyze, but also then we track. Because when we meet a company, whether we take the mandate or not, we stay in touch with them. So sometimes we see business plans and we get to check 1 year later, 2 years later. So we have a long track record of seeing business plans and companies delivering or not delivering on those business plans.
Yeah.
So we have an experience in seeing business plans that are realistic and business plans which are unrealistic, and we can recognize them. And it's based on really a lot of data, a lot of analysis. Mm-hmm. And also when you speak to different people in the company, like the shareholder, the CEO, the CFO, they will also give you a different angles on the same business plan. And as bankers, we try to go with the most conservative view because the people we're presenting the transaction to.
Because you're bankers.
Because we're bankers, and also because the buyers are even more conservative than bankers.
Okay.
Yeah, because imagine being a family group or a corporation or the head of business development at a large company and trying to buy a company. You're also going to take a very conservative view.
Yeah.
And we want to impress you positively by showing that our management team has the ability to predict or to make a good budget and to beat their budget, as opposed to underperform.
Yeah.
Yes.
Yeah. And what else goes wrong?
This is the main one. The other things that go wrong is things go wrong on the buyer side. Mm-hmm. So without naming it, we were working on a transaction a couple of years ago, and we were in a very advanced stages of selling the company, which is our client, to a listed company.
Okay.
And the share price of that listed, and we were at the last minute when we were really inking the final documents, the share price of that listed company tumbled because of reasons related to the buyer in this case.
Okay.
So while everything was fine on the side of the company that was for sale, in this case, it was something that happened on the buyer side. So it's less frequent, but it's up there in the list of many things that can go wrong.
What else?
The third thing is just time is the enemy of M&A. The passage of time results in so many things like the ones I listed, but so many other things happen. People change their minds. People change. Like, we've seen, because deals take so long, and that's we're always asking.
What's the average time, duration to close a deal?
Nobody would tell you this. We say it in a pitch, but transactions from the time you meet the company to the time that you close and have the money in the bank easily take more than 12 months. So we've closed transactions faster than that, but that's the exception rather than the rule, and we try not to promise that. Typically, our kickoff documents or our pitch decks say that from the minute we start work to the time when we sign the documents is 7 months. That is realistic and that can drag, but you have to realize that we start work after the engagement letter was signed. To get to an engagement letter, it could take a couple of months.
Yeah.
And then from closing to completion, i.e. the money in the bank, it could be days, it could be months. We've had a transaction where there was multiple months before all the conditions precedent were completed. So, and in this part of the world, this is not like this in New York. In New York, transactions do close in 6 months. They do. They complete, or sometimes 3 to 6, depending on how sophisticated the parties are.
So why don't they close here? What's the issue?
Here, there are so many things that mean it takes longer. Holidays,
Holidays.
Yes.
Holidays.
The first Eid, the second Eid, summer holidays, Christmas, New Year. So we have so many holidays.
Okay.
And people do slow down. A cultural relaxation with regards to anything to do with time. Like people both on all sides, whether they are sellers, buyers, advisors, present company excluded, who don't value present company excluded, who don't value their own time, who do not have a sense of urgency about, marking up documents, responding to information requests, showing up for meetings on time, finishing meetings on time.
Okay.
So there is definitely a cultural aspect, which I think everybody here experiences in, whether you try to renovate a house or open a company or close a company, that everything takes longer than it should. And we're living in Dubai, which is known as the city of efficiency, etc. So things are getting better. People are becoming more professional, but we're not in New York. And by the way, what I'm saying also applies, if New York is the highest speed, then London is slower, Paris is slower. And as you go east and as you go south, things get slower. So it's not only the privy of the
GCC or the Middle East.
Yeah, absolutely not.
Okay, so time is the worst.
Time is the enemy of deal making. Things change, wars happen, stock markets crash, people leave their jobs, management changes, strategy at the buyer side can change. Competing opportunities. If you're even if you're a corporate buyer, you're looking at many deals at the same time. So if our client does not, get to the top of the list and close quickly, another target, which may be as or more exciting, could take the priority. And buyers, whether they're corporates or financial investors, have limited firepower and limited human talent and bandwidth that's available to analyze and process and close transactions.
I think this applies to everything, right?
Yes.
I mean, time, right? It's not only in an M&A deal, but also
exactly any project
in a job interview process, right? I mean, things change, right?
Absolutely. You want to beat the iron when it's hot. You want to move.
So how do you do it? How do you get people to move faster?
So we
Because
first...
you come from that culture, right? You've worked in Goldman Sachs and in Merrill Lynch, and you're like, efficiency and...
Deal making. I've been doing deal making in various segments, not only in M&A, but in capital markets, in London, in Paris, here. So I've dedicated the last 30 years to close deals.
Yeah.
And my team, everybody is the same. Everybody has done their entire career just in M&A. We first explain this to clients. Generally, because obviously we advise our own clients first. And generally our clients understand this. There may be differing degrees of understanding, but we keep reiterating the message. That's number one. Number two, we do our part, which is we work extremely fast. We have priorities. We also try not to waste time on things which are less important. So that's one of the things also that is great with working with the boutique, is that we are very nimble. We do not have heavy administrative procedures, the necessity to jump through, an unnecessary or an inefficient process to get things done and get things approved. And that comes also with a senior focus. So myself, my partner, we're working on all the deals ourselves. So it's not like some junior team needs to take things for approval to us. No, we're there on the call with the client, giving the advice in real time. So we do our part, definitely, to make things go faster.
I guess, though, what I'm trying to get to is for everybody who's listening to this, who may not necessarily be working with a third party like yourselves, but who is fundraising, for example, and that takes a long time. I mean, I know some startups that are very close to me who, for example, were in discussions for a potential very large check, and then last minute, things change because actually the management on the other side changed.
The story I just described, yes.
So what's your advice to them? Like, you're a deal maker. What should they do? So even irrespective of, like, they're not working with an advisor.
Yes,
but, like,
of course.
What do they do?
No, whether you're on your own with an advisor, whether it's an M&A deal, whether it's any contract. I mean, the same applies to a commercial.
Any contract, you're right.
Commercial
Getting a client signed.
Any commercial negotiation, yes.
What's the secret sauce?
Don't waste time, prioritize, and learn to compromise. The best clients I've worked with impressed me with their ability to compromise.
Nice.
And particularly when they are faced with a counterparty who is themselves administrative, does not value time, attaches too much importance to small details. So the most impressive clients, people who sold their business, they were our clients. I have learned from them, and I wish every founder, every business owner would learn from them, which is understand what's important for you.
Yeah.
Pick your battles. The worst thing that people do in this part of the world is everything is their battle.
Yeah.
From the valuation to the last insignificant indemnity and warranty in the SPA, everything is a big deal. But that is not the way to win a negotiation. And that is not the way to move fast. The way to win a negotiation is focus on what matters to your economics, i.e. how much money you're going to get, when are you going to get it? And then you focus on the top 2-3 risks in the warranties and the structure. And then you can compromise on, the more you are willing to compromise, the faster you will move, and the faster you will actually mitigate your real risk, which is that the deal does not go through and you never get that money.
Yeah. How do you, what's your advice on negotiation? Again, you're someone that closes deals, you're representing a company, so your job is to get them the best price, the best terms as well, not only
of course,
the best price. So how do you approach a negotiation?
I mean, the way we approach negotiation is, we identify first what's important for our client. So, for example, for some clients, getting the money upfront is much more important, potentially even than the absolute valuation itself. And for others, it's really the valuation, and they don't mind over time. They even maybe hope to get more money through an earn-out. And that makes a big difference. So then the upfront valuation becomes less important than actually the structure itself, if it allows the founder to stay on board and grow his profits and get higher value for their shares in the future. So the first thing is we try to be very clear with our client what is important for them, and then we drive the negotiation by this. We also try to understand what's important for the buyers. Because the same, and we try to find areas where what is important for the buyer is not what's important for the seller. And this is where you can have win-win scenarios. So there's been books written about negotiation where you can have win-win scenarios where it's not like my gain is your loss. If for the buyer, the absolute number is important, but for the seller, getting the number spread over time solves the problem. That's how we solve things. And we try to avoid those types of negotiation where it's like, my gain, your loss, because that's not very productive. And then when there's invariably a lot of these my gain, your loss, we do, say you're negotiating an SPA and there's literally 20, 30 points to negotiate.
A sale and purchase agreement.
Yeah, sale purchase agreement or the shareholder agreement, which is even more important. Then we try and, we're not lawyers, but we work very closely with the lawyers on that, is we try to bargain certain points against others because we know that we cannot win on all 25 points.
Yeah.
So we try to, again, get to that cooperative situation where the buyers, we sit and listen, we conceded on this, can you concede on that? So we can move on and don't get stuck for weeks on points, which can happen if both parties insist on negotiating and wanting to win every single point.
What is your advice to people who are raising money in terms of how many parties they talk to? I mean, I assume like when you are working on a transaction and you want to sell a company, you approach one buyer or you're talking to multiple people? Is it a fixed price or it's an auction? How does it work?
We typically run a competitive process, which is, as you say, it's an auction process.
So it's an auction, which is a closed auction, right?
It's a confidential, private process where...
is that the best way to sell a company?
That is the typical way to sell a company, yes. Actually, typically, these offers are covered by non-disclosure agreements, so you cannot share them, with others. So it's a bilateral discussion between the seller and the buyer. It could be a single round process where you immediately identify the party, or it could be a 2-round process where you shorten the list to a few selected parties, you give them maybe additional information, and you ask them to fine-tune their offer, which could be the structure or the price or the terms that we discussed earlier.
Because that's how you can potentially get the best deal,
So
right?
the advice is to founder or to business owner who gets approached to sell this company, or even for raising capital, but more importantly for selling the company, is do not go ahead with the first party that approaches you. Use this as an opportunity to run a competitive process and get the best terms for you and your investors. Maybe you'll still go ahead with these people because typically these people approach you, you like them, they've done a good job, presenting themselves to you. But do yourself a favor and double check that there isn't another 3 equally attractive investors who may add value to your company, or, if you're focused on valuation, bring you a higher valuation.
Yeah, don't leave money on the table, basically.
Typically, founders, business owners say that they want maximum value, but they easily go down that road of just going with one party. Yes,
big time.
The one caveat to that, say you're in a very early stage company and time is of the essence.
Yes, you don't want to spend
and the terms look fair, and it's a small minority. You may want to arbitrage the time against the optimizing the deal to perfection. Yeah. But if you're selling a business, which is your life's work, and as we said, people 10, 15 years, sometimes we have clients who inherited the business from their parents. It is worthwhile investing the time and the effort into hiring a good advisor, running a proper process, going around the market, and seeing if you're doing yourself justice.
I attended a talk about negotiation recently, and one of the tips the guy gave was basically, if let's say you want to sell to these 3 people and you have a priority in terms of I want to sell to Ziad first and potentially the other 2. He said one good way to do it would be to go to the number 3 people and try to get a deal from them. So then when you walk into your number 2 opportunity, you're actually going in very strong. And hopefully if you get a deal from number 2, then you go to your priority target, basically with a much stronger, more confident stance, let's say. What do you think about? Do you do this?
We try to be fair to all buyers and investors. We approach them all at the same time with the same information, and then we send them a process letter asking them to give their offers at the same time.
So there's no dry run with the least important.
Yes.
Let's
now
say.
Sometimes again, because this is part of the world, people ask for extensions and whatnot. But we try to be fair and give more time to everybody as well.
Okay, but you won't approach your kind of the least priority and then go to your top priority.
Not in an M&A process. I can see how that makes sense. Maybe, I don't know if you're looking for a job So there's different things you can negotiate in different ways. Yeah.
What are your views on crisis management? So if something happens reputationally damaging or you are connected to people maybe or worked with people, how do you distance yourself, or how do you deal with a scenario like that where you say, what do you do in that situation?
Yes, I've seen good examples. A long time ago, we were working with a technology company, a fintech company, which was involved in payments. And there was a major hack that happened that impacted, I think it was a very long time ago, their systems and those of other fintech and payments companies. And I saw them manage that brilliantly. They hired a PR agency. They had a PR agency actually on call, ready for a situation like this. And they were very upfront about communicating about the problem. And they actually even made an opportunity out of it because they came up with a cybersecurity solution, which would prevent something like this from happening again. And they started offering it to their clients. So I think there are professional ways of dealing with situations. I think the worst thing that can happen, and we've had that on other situations. We had a client who had a major legal issue. One of their shareholders had a major legal issue, and the management team called us at the weekend telling us.
Called
the advisor and said, this is happening. Our shareholder is having a legal issue. We need to put the process on hold. We need to see where this goes. So people, I can say I'm pleased with how we've seen some of these things being managed. I think the key is to be honest, upfront, show integrity, and then sometimes you can even turn it into an opportunity.
Yeah.
The worst thing is try to hide things.
Yeah.
The second
or
worst
not
thing
act on it, right?
Or not act, or even try to be apologetic about it. I think just try to stick to the facts and be honest and it's called being brave, being courageous in business. That's an important thing in business generally. Bad things happen and you have to be brave, you have to be honest, candid.
You've had the opportunity to be in a leadership position in a great global business, obviously businesses, and then you went to become an entrepreneur. Is there something that people in the corporate world can learn from entrepreneurs and vice versa?
So, the decision to go from big company to entrepreneurship is something that's been happening more and more frequently since the great financial crisis. And that's how we've seen the rise of, boutiques from the US to Europe to Middle East and emerging markets. It's been in response to demand from clients. The big driver of that was that huge growth in the US capital markets, which led to the big banks dealing with bigger and bigger clients and bigger transactions and fees. That created the opportunity to the very good companies, which, as I said, are smaller but are very good companies and deserve good advice, to be advised by people outside of those big institutions. Yeah. So that is the story of investment banking boutiques and why they exist and why they're growing.
What made you leave that job?
What made me leave that job is, not on one hand, the opportunity to address that market and to serve those entrepreneurs. And more specifically to me, I really enjoy actually working on the transactions and working with entrepreneurs, finding a buyer, negotiating the deal. And when I was a senior MD at Merrill Lynch, we're talking, this was 12 years ago, already as a senior MD, you're asked to focus only on origination and also on management and on internal matters. And origination is basically you bring the client through the door and then you move to the next one. But I like that the experience of taking the client by the hand from the beginning until the end. And I also like working with the entrepreneurs and the business owners directly. Yeah. While at the big banks, you're most of the time dealing with the giant government institutions where you're dealing with very professional people, but who are actually employees as opposed to business owners. Mm-hmm. So I have this passion for working with business owners and helping them achieve their dream, whether by growing their business or selling it. Mm-hmm. The question you asked
was there something that people that were in your position, for example, can learn from entrepreneurs and vice versa?
Yeah, I think, definitely in Awad Capital, we obviously educate our clients and we learn from them all the time. It's a kind of symbiotic relationship. I think at the big banks, there are some big banks where you can be an entrepreneur within the institution. But you can ask my friends who are still at the banks, this is becoming harder and harder with time because these institutions, as they become bigger, as regulations become heavier, as they become more kind of globalized and interlinked, the room of maneuver becomes more and more limited. And, your role as a banker, even as a senior banker, becomes more and more siloed. So I think it's important for anyone doing the job to be enjoying it. That's the most important thing. And that's one of the reasons myself and all, my colleagues and all the people who follow our path are doing what they're doing is because they enjoy what they do. They enjoy the entrepreneurship. They enjoy the independence. They enjoy working directly with the entrepreneurs.
But is there an insight you learned from being an entrepreneur that potentially maybe people don't appreciate on the outside or?
I think, yes. I think from being an entrepreneur myself and all my clients being entrepreneurs, the insight that the world doesn't realize is how hard it is. Mm-hmm. It's obviously if you've been an entrepreneur for 10, 11, 12 years, you have not failed yet for that length. And people generally, the public is very, very impressed with that. And obviously what you don't realize is you see the glory, you see the success, you see whatever, people measure success by, but the hardships that go along the way are, not to be underestimated.
Yeah. Okay. Well, thank you so much for your time.
Thank you.
Really enjoyed our discussion.
I'm so happy to be here. Yeah.
Thank you so much for tuning into this episode of Conversations with Lulu with my guest Ziad Awad, the CEO of Awad Capital. If you want to learn more about their business, you can visit awadcapital.com. Don't forget to visit conversationswithlulu.com to check out all the other episodes, and make sure you hit the subscribe button or the follow button wherever you are listening or watching this episode. You can take a few minutes to leave us a rating and a review. It really helps us in getting the show discovered. And make sure you are sharing this episode widely with friends, family, colleague, and whoever could benefit from this content. Thank you so much, and see you in a few weeks.